And we're back, and we promised at the top of the hour we'd have an in-depth review of these guys out of Indiana who are making a whole lot of noise. Ozem Mayo and Joe Crump with BigRia.com. These guys have figured out how to turn $200,000 into $100,000 a year in passive income for life. They do this by helping folks around the world invest in Indiana real estate without leaving your house. They have thousands of success stories from people around the world, and in fact, they have more success stories and are the most successful millionaire makers in the Midwest. Mayo is absolutely brilliant and is doing amazing work in the field of special needs. Crump is an Emmy-nominated filmmaker, and these guys still found the time to build this company, and today we're going to talk about their GRS program. So here's that review. Let us know what you guys think. The phone lines are open.
Hey, everybody, and welcome to another Deep Dive with us. Today, we're going to be exploring Indianapolis turnkey real estate investing.
Oh, yeah.
Which, may sound a little bit complicated at first, but we're going to break it all down together. Ozem Mayo and Joe Crump, who are two very prominent real estate investors.
Right.
And plus some insightful study notes you've shared with us.
Yeah.
Our mission today is to understand turnkey real estate.
Okay.
See if it might be the right fit for passive investors like you, and ultimately explore its potential for building wealth.
What's really fascinating about turnkey real estate is the allure of passive income. But it's so essential to understand the nuances before diving in.
Absolutely.
Yeah.
So let's just start with the basics.
Yeah.
What exactly is turnkey real estate investing?
You can think of it as a done-for-you approach to owning rental properties. Ozem Mayo and Joe Crump define turnkey real estate as properties that meet three key criteria. They are fully renovated and repaired, ready for immediate rental, and managed by a dedicated property management company.
So you're essentially handing off all the day-to-day hassles of being a landlord.
Precisely. It's designed for passive income without the hands-on demands of traditional landlording.
Sounds pretty appealing. But is it really for anyone?
Not quite. Mayo and Crump highlight a specific investor profile that's best suited for turnkey real estate.
Okay.
They emphasize that this strategy works best for someone who's comfortable with a passive investment approach, meaning they're trusting experts to handle the day-to-day operations.
Okay.
They also suggest a substantial income level, ideally between $100,000 and $200,000 annually.
So it's not necessarily an entry-level investment strategy?
Right.
You need a certain level of financial stability to get started.
Exactly. And lastly, they stress the importance of an excellent credit history. This ensures you can qualify for the financing needed to acquire these properties.
Makes sense. Good income, good credit, and a hands-off mindset. Got it.
Yeah.
Now let's talk about the companies that offer these turnkey services. What are the different types out there?
Mayo and Crump identified two main categories: large national companies and smaller local companies.
So it's the classic trade-off, the convenience and scale of a large company versus potentially the more personalized service of a smaller local firm. What are some things we should consider when weighing those options?
With national companies, you benefit from their established systems and their broader reach. However, that can sometimes mean lower returns and less control over individual property decisions.
Okay.
Smaller companies might offer more personalized service and potentially better returns, but thorough vetting is crucial to ensure that they are reputable and reliable.
So it's about balancing those pros and cons carefully, especially when considering a smaller company.
Right.
Now let's address the elephant in the room.
Okay.
Risks. What are the potential pitfalls that investors should be aware of?
Mayo and Crump highlight three primary risks: property misrepresentation, unfavorable locations, and poor property management.
Okay, so let's unpack those a little bit.
Yeah.
Property misrepresentation, what does that look like?
It's when a property isn't quite as renovated or in as good of condition as advertised.
Okay.
It could involve hidden damages or shoddy workmanship that could later require costly repairs.
And an unfavorable location, I can see how that would be an issue.
Absolutely.
Low rental demand, high crime rates, or even just being in an area that's hard to resell. Those are all red flags.
Location is critical in real estate, and a poor location can significantly impact your returns and your long-term success.
And finally, poor property management. Even if the property itself is great and it's in a good location, if the management company is ineffective,
yes,
it can still lead to problems.
Precisely. Inefficient property management can result in tenant problems, high vacancy rates, and ultimately financial losses for the investor.
So we've got these three key risks: property misrepresentations, unfavorable locations, and poor property management. The million-dollar question is, how can investors avoid these pitfalls and choose a reputable turnkey company?
They offer some really valuable advice. First, scrutinize the company's marketing, paying attention to how they target both buyers and sellers.
That's an interesting point. Why is it important to look at how they market to both sides?
It gives you insight into their ability to secure favorable deals. If they can successfully attract sellers with properties that need work and buyers seeking passive income opportunities, it demonstrates that they're effective at managing those transactions.
So you're seeing the bigger picture, you're understanding their overall approach.
Yeah.
What else should investors consider?
Transparency and open communication are essential. You should feel comfortable contacting the company, asking questions, and receiving clear and straightforward answers about their investment strategy and processes.
So it's not just being sold on the idea, it's establishing that relationship, built on trust and open dialogue. What else should we look for?
Perhaps the most crucial piece of advice is to demand proof of successful outcomes.
Okay.
Don't settle for vague promises. Instead, look for detailed case studies and verifiable testimonials from other investors who have achieved the returns they were promised.
So proof is key.
Yes.
Actual results speak louder than marketing hype.
Absolutely.
What other insights do Mio and Crump offer?
They emphasize the importance of understanding the company's investment algorithm, their process for selecting and managing properties to achieve specific investment goals.
So don't be afraid to ask the tough questions about how they operate and what strategies they employ to generate returns.
Right. Now, Joe Crump brings some additional insights to the table that I think are really interesting.
Okay, I'm all ears. What does Joe have to say?
He mentions working with investors who might not meet that higher income threshold, but are eager to learn and take a more active role in their investments.
So there's potentially a path for those who are still building their financial foundation, but are committed to learning the ropes and taking a more hands-on approach.
That's right. Also draws a really compelling comparison between real estate and stocks, highlighting some key advantages of real estate.
I'm always fascinated by that real estate versus stocks debate. What are some of Crump's arguments there?
He argues that real estate acts as a hedge against inflation, especially through rising rents and property values. This protection is particularly valuable during times of economic uncertainty.
That's a strong argument. What else does he highlight?
He emphasizes the tax advantages of real estate, specifically the ability to cash out equity through refinancing without immediately triggering capital gains taxes, unlike selling stocks.
Ah, the power of tax advantages. Being able to access your equity without taking a big tax hit right away. Yeah, that's a big one.
Yeah.
Anything else?
His final point is that with real estate, your equity continues to compound even when you cash out, which is not the case with stocks.
That's a really good point. So your wealth building potential isn't limited to just appreciation. It's also fueled by that ongoing rental income.
Yeah.
Even if you tap into some of your equity.
Yeah.
It's a long-term game, right?
Precisely. And this brings us to Mio and Crump's Get Rich Slow GRS program.
Get Rich Slow.
I
love that name. It implies a focus on sustainable long-term wealth building.
Yeah.
Tell me more about it.
So this program focuses on building wealth through turnkey real estate with a long-term perspective. They mention it requires a significant investment of around $200,000.
There's that $200,000 figure again. Seems to be their sweet spot for the ideal investor.
Yeah.
What are they aiming for in terms of returns?
Their goal is to help investors reach $100,000 in annual passive income over a 10 to 15-year period.
Maybe this is a good point to pause and gather our thoughts. Before we dive into part 2 of our Indianapolis turnkey real estate deep dive.
Sounds good. Welcome back. As we delve a little bit deeper into the world of turnkey real estate, I'm curious to hear what's resonating with you so far. What's really piqued your interest in this approach to investing?
Honestly, the emphasis on outcomes has really stuck with me. It's refreshing to hear Mio and Crump focus on tangible results rather than just making lofty promises.
It speaks volumes about their commitment to transparency and actually delivering on their claims. They're essentially saying, don't just take our word for it. Look at what we've accomplished for other investors.
Exactly. Show me the money. Or rather, show me the satisfied investors who are achieving the financial outcomes that they were looking for. Speaking of achieving those outcomes, let's go back to those risks that we discussed earlier. Property misrepresentation, unfavorable locations, and poor property management. What are some practical steps investors can take to protect themselves from these pitfalls? We know we need to demand proof of successful outcomes, scrutinize marketing materials, and insist on open communication.
Right.
But how do you actually PU those principles into action?
It begins with asking the right questions.
Okay.
Don't hesitate to dig deeper, request detailed information, and verify claims. For example, if a company boasts about their high rental yields, ask for the data that supports those claims. What were the specific expenses involved? What types of properties were involved?
So it's about moving beyond the vague statements like, our investors are thrilled and demanding concrete evidence.
Yeah.
What else can investors do to ensure they're making informed decisions? Do your homework. Just like you would with any significant investment, whether it's a car, a house, or even a high-end coffee maker, research is essential.
Absolutely. And remember, you're not just investing in a property.
Right.
You're investing in a company. Research their track record,
Yeah.
their leadership team, and their values.
Well,
Do they align with yours?
that's a great point. It's about finding a company that you can trust, one that feels like a true partner
Right.
in your wealth-building journey.
Yeah.
Now let's kind of shift gears for a moment and talk about the buy and hold strategy
Okay.
that Mio and Crump advocate for. They seem to be big believers in this approach.
Yeah, they're strong proponents of building long-term wealth through equity growth and rental income. It's a strategy that's proven successful for countless real estate investors.
For sure. Could you break down the core principles of buy and hold for our listeners who might be new to this concept?
Certainly, the buy and hold strategy is at its core about acquiring a property with the intention of holding on to it for an extended period, generating ongoing rental income, and benefiting from appreciation over time.
So it's the opposite of flipping houses, where the goal is to buy low, renovate quickly, and sell high for a quick profit.
Right.
With buy and hold, it's patience and a long-term perspective that are key.
Precisely. It's about building a portfolio of income-producing properties that generate consistent cash flow and steadily appreciate over time.
So you're not chasing quick wins. You're building a solid foundation for lasting financial security. What are some of the primary advantages of this approach?
First and foremost, it provides a steady stream of passive income through rent.
Okay, that's definitely appealing. The idea of money consistently flowing in without constant effort is certainly attractive.
Another advantage is the potential for long-term appreciation.
Okay.
Historically, real estate has tended to increase in value over time, although it's important to remember that past performance is not a guarantee of future results.
Of course, no guarantees in the world of investing,
Right.
but historical trends can provide some helpful insights. What about those tax advantages we discussed earlier? How do they factor into the buy and hold strategy?
Tax benefits are a significant advantage for real estate investors. There are numerous deductions and credits available, which can substantially reduce your tax liability.
So you're not only building wealth, you're also potentially keeping more of that wealth.
Yeah.
Thanks to those tax advantages. Sounds like a winning combination.
Yeah.
But I'm sure there are downsides to consider as well. What are some of the potential drawbacks of the buy and hold approach?
One of the main drawbacks is that real estate is not a liquid asset.
Okay.
It can take time to sell a property, especially if market conditions aren't favorable.
So unlike stocks, where you can quickly sell and access your cash,
Right.
real estate requires more of a long-term outlook.
Exactly. Another consideration is the ongoing expenses
Okay.
associated with owning rental properties. Property taxes, insurance maintenance repairs.
Right.
These costs can impact your profitability if not carefully managed.
Yeah. Those unexpected expenses can really derail your plans if you're not prepared.
Yeah.
Which is why choosing a reputable turnkey company with a solid track record in property management is so crucial.
You've hit the nail on the head. A reliable property management company can handle those day-to-day tasks and help mitigate those unexpected headaches.
For sure.
However, even with the best property management, inherent risks exist in real estate investing.
Right. It's not a foolproof system.
Yeah.
Speaking of risk, Mio and Crump presented some really interesting arguments comparing real estate to the stock market.
Yeah,
Didn't they kind of suggest that real estate is in many ways a safer investment?
they did.
Okay.
Let's explore those arguments in more detail.
Yeah, let's delve into this real estate versus stocks comparison.
Their primary argument centers around the concept of inflation hedging.
Could you remind us what that means and why it's relevant in the context of real estate?
Inflation hedging means that an asset tends to hold, or even increase its value during periods of inflation, protecting your purchasing power.
Okay.
Real estate often acts as an inflation hedge because rents and property values tend to rise along with inflation.
So your investment is kind of shielded from that erosion of purchasing power that can happen with other assets
Right.
during those inflationary periods. What other points did they raise?
They also emphasize the tax advantages we discussed earlier, specifically the ability to withdraw cash through refinancing without immediately incurring capital gains taxes,
Okay.
unlike selling stocks.
Right. So you're able to access your equity without taking a big tax hit right away, which provides more flexibility.
Exactly. Finally, they pointed out that with real estate, your equity continues to compound even when you cash out, which is not the case with stocks.
That's a really good point. So you're not solely reliant on appreciation. You're also building wealth through that ongoing rental income.
Yeah.
Even if you choose to access some of your equity.
Precisely. Now, while we've highlighted these advantages, it's crucial to acknowledge that risks are associated with NAME investment, and real estate is no exception.
Okay, so we talked about the specific risks associated with turnkey investing.
Right.
But what are some of the broader risks to consider when investing in real estate in general?
For one thing, the real estate market is cyclical. There will inevitably be upswings and downswings.
So there's that risk of buying at the wrong time.
Yeah.
Experiencing a market downturn and potentially losing money.
It's a possibility, although. With a long-term buy and hold strategy, you're more likely to weather those market fluctuations and ultimately come out ahead.
It's a long game.
Right.
It requires patience and perspective. Another potential risk is unexpected expenses.
Absolutely.
Even with a turnkey property, unforeseen issues can arise.
Major repairs, tenant damage, property tax increases. These unexpected costs can significantly impact your returns if you're not financially prepared.
And that's where having that solid emergency fund and a well-managed budget becomes essential.
Exactly.
It's all about being prepared for the unexpected. Now let's circle back to something you mentioned earlier.
Okay.
That idea of finding a turnkey company that feels like a true partner. I think that sense of partnership is so crucial.
Right.
When you're trusting a company with such a significant investment. But how do you go about finding that ideal match?
It starts with self-reflection.
Okay.
Ask yourself, what are your investment goals? What level of risk are you comfortable with? What kind of support are you looking for from a turnkey provider?
So defining your needs and expectations up front is key.
Yeah.
Then you can start seeking out companies that align with those criteria.
Precisely. Don't be afraid to shop around. Talk to multiple companies. And compare their approaches, their values, and their track records.
That's like dating for investors.
Yeah.
You need to find that perfect match that understands your financial aspirations and can help you achieve them.
I love that analogy. Now, one thing that really stood out to me in the material we reviewed is Mio and Crump's consistent emphasis on their track record.
Right. They're really big on outcomes.
Yeah.
Look at what we've achieved for other investors.
Look what we've done.
But how do you actually measure those outcomes? What are the key indicators of success in turnkey real estate?
That's a great question. They highlight factors like the number of successful deals they've facilitated, the average return on investment their investors have achieved, and perhaps most importantly, the number of individuals they've helped attain financial freedom.
So it's not just about profits. It's about impact. It's about empowering people to reach their financial goals and create lasting wealth.
Exactly. Now, before we wrap up this part of our discussion, there's one final thought I'd like to share.
Okay. I'm intrigued. What's on your mind?
We've extensively discussed the turnkey model, which centers around passive investing. However, Joe Crump mentioned that they also work with investors who desire a more hands-on approach.
Right. He talked about investors who may have more limited capital, but are eager to learn and actively participate in the process.
This raises an interesting question. Is there a way to blend the benefits of passive investing with a more active learning approach? Could investors potentially gain greater control and maximize returns by combining these two strategies?
That's a fascinating concept in turnkey real estate investing, ranging from completely hands-off, gauged participatory approach.
Exactly. Let's explore that idea further when we return for the final part of our deep dive.
So we've been talking about Indianapolis turnkey real estate investing as a mostly passive approach, but is there a way to kind of blend that with active learning? Could you start passively and then shift to more of a hands-on approach as you gain experience?
That's a really intriguing concept. It could be a fantastic way to maximize your returns while still benefiting from that initial guidance and support of a turnkey company. You could start with a turnkey property to kind of gain a foothold in the market and generate that passive income. And then as you learn more about deal structuring, property management, and the Indianapolis market, you could gradually transition to a more active role.
So it's almost like having a mentor in the real estate world. You start with their expertise and their guidance, and eventually you're confident enough to go solo.
Right.
But with this blended approach, you've got that safety net and that knowledge base to draw from.
Exactly. And this kind of ties back about working with investors who have limited capital but are eager to learn.
Right.
It suggests that there's flexibility within the turnkey model to accommodate different levels of involvement and financial resources.
That's encouraging. It means turnkey real estate isn't just a one-size-fits-all approach.
Yeah.
It can be adapted to suit your individual goals and your circumstances.
Absolutely. Now, let's kind of zoom out for a moment and recap some of the key takeaways from our deep dive into Indianapolis turnkey real estate investing. We've learned that it can be a viable path to passive income and wealth building, but it's not a get-rich-quick scheme.
Right.
It requires a long-term buy-and-hold mindset and thorough research, due diligence, and selecting a reputable company with proven results are absolutely non-negotiable.
It's about focusing on outcomes, not just promises.
Yes.
And remember, even within the turnkey model, there's potential for a more customized approach, blending that passive investing with active learning to potentially amplify your returns.
You've captured the essence perfectly. It's all about finding the right balance for you and your investment journey.
Well, this has been a fantastic deep dive into Indianapolis turnkey real estate investing.
Yeah, it has.
Thanks for joining us and for providing these insightful materials.
It's been a pleasure exploring this topic with you.
And all of our listeners out there, remember, knowledge is power, and informed decisions are the foundation of successful investing. We'll see you next time.